Let's take you to South Africa now, where the country's Reserve Bank has released its latest monetary policy review, outlining key domestic and global development influencing monetary policy. The report issued earlier today provides an in-depth analysis of economic trends, inflationary pressures, and growth prospects shaping the bank's policy outlook. The monetary policy review is published twice a year as part of the Reserve Bank's efforts to enhance transparency and public understanding of its decisions. Governor Laseja Keyago and members of the Monetary Policy Committee also engaged with the public following the release, discussing the findings and addressing questions on South Africa's economic trajectory.
The global economy has been through a period of extreme uncertainty. Just returned from the meetings of the IMF and the World Bank in Washington. And as it happens, where you have got lots of economies from different parts of the world, there are lots of disagreements with people having different takes on one thing. There is one thing we all agreed on, and it is that we are in an uncertain environment, and this uncertainty is going to be with us for some time to come. So we came out of Washington with something that we could agree on, something very rare, because economists like disagreeing. But as we stand today, trade disputes and geopolitical tensions are in the spotlight. It is only in April, as we were going to the spring meetings of the IMF and the World Bank, that there was an announcement about tariffs, and it added to the uncertainty. A week before the annual meetings, now in October, another announcement on tariffs. We thought that we had it, and we left Washington, and then we got here and we heard that there are further actions. So it is a very volatile environment that we are in. And all of these tensions, trade and geopolitical, are likely to slow down global growth and keep inflation in focus. Here at home, growth has exceeded expectations in the second quarter, lifting the projected annual growth rate slightly. Continued reforms remain crucial to unlocking South Africa's growth potential. Inflation has stayed low and stable, closer to 3%. During the review period, the MPC reduced interest rates by 50 basis points, bringing the cumulative easing since September 2024 to 125 basis points. At our most recent meeting, the MPC decided to pause further rate reductions to allow time to assess how previous easing is filtering through the economy and to monitor how inflation risks change. In July, the South African Reserve Bank announced a preferred inflation objective of 3%, aligning South Africa's long-term inflation rate with that of its major trading partners and peers. The Sarb remains committed to its constitutional mandate of price stability. Low and stable inflation protects the buying power of all South Africans, especially the poor. It also creates a more conducive environment for investment and job creation. A low and stable inflation basically means that inflation is removed from the decision equation of businesses, of labor, and of households, because it is no longer the case, or will no longer be the case, that South Africa stands out as a country with higher inflation compared to peers. We will be aligned with those of our peers. And as one was going through Washington, between David, Rashad, and myself, I don't think I'm overestimating if I say that we had seen just over 300 investors. There were others who were double dipping, who were attending this meeting and that meeting, so there might have been double counting, but just over 300. And it was in no doubt that South Africa was basically the flavor of the discussions amongst emerging market peers. And of course, you guessed right. The first question was always 3%, and when are you really announcing exactly when is that the formal target? And the answer was standard. The inflation target range is 3 to 6%. The South African Reserve Bank prefers inflation to be at the lower end of that inflation target range, being 3%. That was, in essence, all the other things that we were discussing were subsidiary to that.